Bank is down about 0.75%. 51,300 is where the Nifty Bank is at. Look at the advanced decline there at the bottom, but it's very early to sort of draw any conclusions of that. But it's more advanced, more stocks up than more stocks down, at least right out of the gates. IT index is down about 0.6%, and we look at a few others as well in a bit from now. But this is the first rates on the indices, frontline indices, which are coming through. It's a 0.5% cut at 9:15 on the Nifty, 23,378.
You know, with the opening today, the Nifty is even lower than last week's low, which was 23,398. So at the opening level, the Nifty has taken out that lower low. The top loser is Cipla, down close to about 2%. Ekta was talking about it. Sectorally, the biggest drag is coming in from the PSU banking names. State Bank of India is under pressure in the frontline bank. Metals is weak. The Nifty Metal Index is a cut of over 1%. And here, the notable losers include Tata Steel and a JSW Steel. So Tata Steel is down close to about 1.7%. Banks too are dragging their feet. The Nifty Banking Index is down 400 points right now. The big loser is IndusInd Bank, so that's 2.3%. It's overtaken Cipla now as the top Nifty loser, but HDFC Bank too is under severe pressure. On the gaining side, you've got strength in Sun Pharma, ITC, Wipro. Remember, there is that Sensex change which is taking place, so Wipro is going to be out. But Wipro is up close to about 0.5%, and there is a little bit of an underperformance that you can see in the broader markets too. So the Nifty small cap index, I think when I last checked, it had a cut of close to about 0.6%. A little bit of an underperformance, and the advanced decline ratio is in favor of the losing side. But lots of individual stocks in the broader market.
A lot of individual stocks in the broader markets. In fact, now as we speak, the advanced decline has moved in favor of declines. About 1,200 stocks in the broader markets lower as against 880. We opened with an equal number of stocks advancing and declining. And straight off the bat, the usual suspects which are expected to decline, we have, the fertilizer pack. All of those fertilizer stocks are lower in today's trading session at the open itself. So you pull up something like a fact, which is down about 5%. We are seeing a cut in RCF, Dhanuka Agritech, GNFC, all of them down anywhere between 2 to 5%. Remember, these had already seen some selling on Friday, and that continues even now. Delta Corp is down about 6%. There wasn't, any significant relief that came in. In fact, wasn't even on the agenda. That stock's lower. The reason why metal stocks perhaps could be lower is also because of the strength that we saw in the dollar. As Manisha pointed out, that's weighing in on commodity prices. So as a result of which, something like a Nalco, SAIL, all of them are lower too. Pharmaceutical pack is doing relatively better. So we have Alembic Pharma as among the top F&O gainers. And Sun Pharma too, like Ekta pointed out, has been doing well. This on account of the outcome of their phase 1 of their obesity drug trial. Another bunch of stocks which are actually active in today's trading session. Garden Reach Shipbuilders up 6%, a big order coming in on that one. And we do have Suzlon, which continues its up move. We are seeing the up move continue on a couple of these themes like rail, where Titagarh Rail Systems is up 5%, Railtel is up around 4%, and paper stocks as well. Something's definitely underway in the paper segment or the sector where prices are increasing, because we have names like JK Paper, which are up around 37-38% this month itself, and another day of an up move of around 4% on that stock.
Well, it's a okay kind of start. 90 points lower. It's a lower start, and about 250 odd points. So from the day's low, we've recovered about 50-60 odd points. But the first initial a few rates which are starting to come through. What do we have? You've got, as I think Mangalam said, Garden Reach, which is the biggest volume-led gainer on the NSE now. It's up 6.5%. Suzlon is at the number 2 position with big gains, about 4.5-5%. Stocks at about 56. There is, I think we mentioned Railtel and Titagarh. Both are up 5 and 6% respectively. Shakti Pumps is coming up with huge volumes. It used to be a very small company with very little volumes, but it's had a one-way move, circuit to circuit, 5%, and it's coming up as, I think, the 5th to the 6th largest volume traded name, at least right now. There is TBO Tech, which is a recent listing where I think Goldman has initiated coverage. And that's interesting, right? I mean, I think you're starting to see some of these marquee foreign brokerages going down the market cap curve. I think last week we had them initiating coverage on MapMy India, which is CE Infosystem. Stock went up 20-25%. And they've done this, something similar on TBO Tech now. What else? KSB is up about 4.5%. We've got Uflex, which is up about 3% or so. Repco Home is up about 4.5%. That's essentially what's going up. And on the downside, I think HFCL is down about 3%. There is a SAIL which is down 3%. Fertilizer stocks all, I think, as Rima and Mangalam mentioned, RCF and NFL and FACT and GSFC, all of them are down. Delta is down about 6%, 133, 134 on Delta. I think Delta had a bit of a move on essentially what the expectations really. But I'm not sure if this is just unwinding, or this is a view being taken now that nothing is going to happen, because I don't think that is exactly the correct interpretation. We'll talk more about this. IndusInd is down about 2.5%. AU Bank is down 3%. DLF is down 2%. There is Swan Energy which is down about 4.5%. Cipla is coming up with a 2% cut. Hindustan Copper is down about 2%. ABFRL is down 1.5%. Policy Bazaar. Actually, there is a lot more volume on the downside today. If you look at the volume-led sort of list, it's more on the downside than on the upside, really. But on the Nifty, it's down about 94, 95 odd points. Maybe just a quick look at the small cap index as well. Small cap index is down about 0.4%. And we'll just look at the mid cap index as well, where there's a 0.4% cut as well. We have Sanjay Parekh, who's with us. He's founder and CIO at Soham Asset Managers, veteran really at asset management. Sanjay, great to have you with us here. Good morning. Thanks for your time. Appreciate it. What's the feel of the market like? I mean, as we kind of now look ahead into this new parliament session and the budget finally, as we sort of go into it, what's your sense? How are the markets likely to behave? It's a sort of near-term question to you, so maybe a little unfair. But what's your sense?
Yeah, so I mean, as we all know, structurally we are very, very positive because all the balance sheets are in place. But valuation is what discomforting to all of us. But having said that, it could be a time correction or 3 to 5% price correction, and after such rise, it is very normal to have. Having said that, in mid and small cap, as we know that the valuation, overvaluation in certain segment is very high. So it will be stock specific that we need to go, and also we have to keep in mind that there are few events like monsoons initially is below normal on an average. The Vahan data on auto also has not been great, and of course the Telangana farm loan waiver. While normally the states have to bear it, but it certainly doesn't augur well from a overall banking system perspective. So when a state government decides to do such populism, it does have a ripple effect on the banking system, even if it not directly. So certainly we have to keep all this in mind because pre-elections there were impact on demand in the first quarter in certain segment, as we hear even in the first or 2 months in cement, autos we are already visible. So we'll have to keep these expectations right, and then as I said, the structurally we're very positive, but we could have a pause or a reaction as well.
Sanjay, morning. In your portfolio or recommendations, did you have any stocks with exposure to the MFI sector where the stress is now increasing and companies are talking about it bringing down their growth forecast? And is it time to turn cautious? Which would be the stocks which could get impacted because of what we've heard from Ujjivan Small Finance Bank?
Yeah, so, yes, as they did say, all of them are talking about gradual increase in credit cost. It's just that, whether the credit cost remains in a band, because the ROAs after even the credit cost, if it's in the band, are still very good. So if, let's say, they can manage it at 3% or so, and then get an ROA of 4.5%, then it's fine, it's worth the business. But if it escalates, which is because it's an unsecured piece, and due to such announcement by the state, as I said, it directly doesn't get affected, but on the credit culture, it does have an impact. So hopefully it is not pervasive, and hence we will have to watch. And such state government's populism, particularly from, because this is not from the BJP government, it's from the Congress government. There's little that can be done, It's the state exchequer which will bear it, hopefully. and there will be certainly an impact on credit culture. So we'll have to watch it as it comes, and hopefully these companies can maintain the credit cost in a band.
Right, just keep an eye out on a couple of these defense-related stocks. Mazagon DOP, for instance, is up around 4% right now. It's been a big mover and continues to move higher. This one could be attributed to some of the news reports that are there this morning, where they could be in advanced talks with regards to Kalaveri submarine deal, which could be worth anywhere between 35 to 36,000 crores. These are newspaper reports, so that stock is buzzing around. But Sanjay, I just wanted your thoughts on this entire rail and defense theme, because everyone's been speaking about how they've run up ahead of expectations, ahead of what the street is, what the fundamentals could be, etc. But there is still no stopping this rally, and day and again there are new news pieces, order wins coming in. How much is too much? Right, we'll just try and repatch that connection. Meanwhile, we're speaking about that, rail and defense. Look at Ircon, up around 4% right now at the high point. We have RVNL, which is up around 4% again at the high point. Defense-related stocks, Paras Defense, for instance, up around 3%. When you're looking at Mazagon Dock, you also look at their twin, which is Cochin Shipyard, because both of them move in the same direction. Cochin Shipyard has moved higher. We were talking about Titagarh earlier. Look at Texmaco, that's too higher by about 2.5%. So a bunch of these stocks continue to do well and continue to make the highs of trade, even when the broader markets definitely are looking a little shaky, with more stocks declining than the number of stocks which are advancing.
No, absolutely. RK Forging, Mangalam, I don't know if there's any news flow. 7% pop there. We'll have Sanjay back with us in just a bit, but look at RK Forging. It's a sharp move on very large volumes on that one. There is a Glaxo, which is showing up. Some of the new stuff which was not there in the mix in the morning at 9:15. Glaxo is up about 5%. There is actually volumes are picking up now on the upside as well. I was talking about how volumes perhaps a little bit more on the downside than up on the upside, but I think it's picking up. Raymond is up about 4%, 26.25 on Raymond coming through. There is what else? JK Paper, I think I saw that in the, right at opening, 5% higher. So yeah, that's essentially broadly the list that we have. Mangalam, I think we have Sanjay back with us.
We do have Sanjay back with us. Sanjay, you were talking about how some of these broader market plays are looking like they've done their course, but price is telling you a totally different thing. I'm looking at the defense and railway related stocks.
Yeah, so Mangalam, valuation again, we participated way early in one of the companies, Jupiter Wagon, and we sold it as well, and from there it's up 70%. So valuation is which I think most of the mature participants are not comfortable with, and I think again comes this active retail with 15 crore demat accounts and 4 to 5 crore active demat accounts. And each of them have individually, as a bunch of together, are a phenomenal power. So that is where I suppose both railways and defense, the theme, because they would not really discuss too much on valuation, and hence they would more give importance to the price, which is done very, very well, and the momentum is there. Having said that, now valuations for a lot of them are discomforting, and that's where we are staying away from them.
Got that. By the way, to your portfolio, Sanjay, from the last time that not from the last time that we spoke, but in the, have there been a few new additions? Publicly disclosed in what you've kind of picked
not
up?
Not much actually. We've just added one name in the infra space, but otherwise, nothing that may have changed major.
Did you see this, the announcements with regards to GST, the changes, etc., which were made, but also the changes which were not made? There was a lot of expectation that maybe they will sort of moot the proposal of bringing gas under the ambit of GST.
Right.
Petrol, diesel, etc., maybe more contentious. But any thoughts on these areas?
No, it does. It looks difficult because, there are impact on exchequer as well. So there is impact on input tax credit that one today doesn't get, but later on they may have to give. So I think the petroleum products is a contentious, even if it is on the gas side, it's not easy, to get a consensus, and then the impact on exchequer as well. So that piece, we are also less hopeful. So that's a view we have on the GST. The rest, of course, the rest of it have not followed.
You're quite underweight on oil and gas, right, Sanjay?
Yes.
Across all the categories? Refiners, oil marketing companies, gas, etc.?
Yeah, so we had HPCL and BPCL and we made significant money, and then we said, so when we bought, it was really cheap and people were overly worried on, the deregulation, whether it'll happen, not happen. And at that time, it was really dirt cheap to buy in. And then, of course, they moved in 70-80%. And of course, we also got the dividends at our cost. The dividend yield we got was 6-7%. But then the risk return did not turn so favorable. And having said that, we've seen the outcome of the elections, and it is not a very clear mandate, as we know. We have coalition government, and hence, at least we believe that it will not be easy to have regulations with a total market-led pricing for petrol, diesel, given the mandate they've got. We'll have to see how they manage this and navigate it. But that is one area where, let's say tomorrow crude goes up $10, whether the oil companies will be allowed to be market-driven, given inflation was a very big issue in the rural India. And hence we want to watch this before we take a call, and hence we are underweight on it.
Let's quickly wrap it up then with your view on the IT space. I mean, there are two schools of thought. One, that it is in for structural derating, or secondly, it's a value bet, the only place where you will get good stocks at reasonable valuations.
Yeah, so we were underweight almost 2 years, significant underweight at just 5% weight. We recently, last a little more than 1.5 months, we increased our weight a bit, but our underweight is still there. So here now, they will have a tough year this year, but the long-term story of can they be at 8 to 10% dollar revenue growth with ROEs and ROCs being so good, payout ratios being so good, and at this juncture of market, the risk return, if your expectation is you make 10 to 12% return and 2, 3, 4% dividend yield, if that suffices, it makes sense to increase the weight bit. Having said that, we are still underweight, and we will look at, because this year is going to be challenging, is what we strongly believe, with a low growth. And last 2-3 years also has been mediocre growth. So one has to be gradual, but the character of the business is very, very good. So once the growth is back, certainly, stocks can move up. And that's how we have cautiously increased our weight in 2 of the large caps.
Okay, Sanjay, you've given us our cue to invite the next corporate on our show. Thank you very much for joining in. Let's talk about technology now. Happiest Minds. Now, HDFC Securities, very recently, they've projected that the company's revenue growth will be 35 to 40% for FY25. The company also has an aspiration to hit $1 billion of top line by FY31. How's the demand environment? Just last week, we had Accenture reporting their numbers. We have with us Venkat Raman Narayanan, Managing Director and the CFO of the company. Venkat, morning. This is Rima here. First, if you could categorize the demand environment for us, what has changed in the last 3 months, according to you? You're on mute.
Yeah, sorry. I'll talk specifically about our company. We started this year on the back of a decently strong year of FY24, where we did about 11.5% dollar growth. So that's the base on which we are now planning to build FY25. We've also started the year with 2 acquisitions, which are now in the process of getting integrated. So that's something that we are working on. And our organic growth engine, which is what contributed to the 11.5% last year, is continuing to fire. And we are looking at all of this put together, helping us achieve that number of about 35 to 40%, which I have called out as an estimate. I've not called it out as a guidance because there are certain puts and takes when you talk about acquisitions. So that's where we are for the year. Coming to the demand environment, we are seeing slow pickup, like other companies and what analysts have been saying. There could be a nice revival in the second half of this year. Like I've always been saying, you can't stay away from technology investments for more than 18 months at a max. You saw this during the COVID period. After COVID, investments into tech came back with a bang, and you had companies do brilliant growth. It's a similar situation. I think the recessionary talk in the US, the dull business outlook of UK, the European region, and the interest rate scenario in the US. This has been what has been, taking all the headlines. And it's in that backdrop that IT companies have also not been given the credit for the growth that they have done in such a scenario. So a company like us, focusing largely on India, largely on US, but we have a disproportionate share in India, about 18-19% coming from India. We are well positioned, to participate in the return of growth, and also in the meanwhile continue to grow organically and inorganically.
35 to 40% estimate that you have, and not guidance, it includes, or it factors in the sort of growth that you are expecting in the second half of this year, right? Or could there be an upside risk to this?
No. This is something that we are estimating as of where we stand today. So it includes both organic and very reasonably good inorganic growth bundled into it. So which is how we have always been giving our estimates. We have not. And
the PureSoft acquisition, because you said that this growth range is subject to completion of these acquisitions. Has that been closed completely? Because you were expected to close it by the end of last month.
Yeah, we have closed both the acquisitions. One is in the middle of last month, and the other is end of last month. So, from an accounting standpoint, that gets us close to 1.5 months revenue for one acquisition and about a month's revenue for the other. So both the acquisitions have closed. We have also intimated that to the exchanges. So now they are integral and they are a part of Happiest Minds, and they are doing decently well.
No, that's good to hear. And gentlemen, morning, Mr. Narayanan, we're talking about being estimate 35-40% growth. You look at, I think when we talk about IT industry, we kind of paint a broad brush, right? You got for some of the larger companies, we're talking about quarterly numbers, 2-3% kind of constant currency growth estimates, but you got your kind of growth rates as well. So there's I guess it's a big market, and you got potential to grow to scale, as you've said. I think you've got a slightly longer term guidance of about $1 billion, right?
That's right.
And yeah, but that's of course many years out. Why do you think, and this is of course not just about Happiest Minds, where there is of course just by the size is small, so there's many years of very strong growth. But why do you think growth will come back? Is it just the cyclicality of it in the second half, or are you actually seeing that? And can we extrapolate that for the industry as well? Or is it specific segments where you operate in, more discretionary, etc.? Go on.
Like I said, companies today are more tech-oriented. Technology is the company. It's no longer, one of the staff functions of a business. Technology is what makes a company. So if you look at it, healthcare has become health tech, manufacturing has become manufacturing tech, education has become edu tech, and so on. So, technology is now a binding factor, and it's a reason for companies to exist and grow. That aside, like I said, you can't stay away because technology obsolescence is so quick. You can't stay away from the market for more than 18 months. So when people talk about tech spend, they are talking about lights on kind of work. So what you have, you maintain, you try to fix it, you try to get the maximum out of it, ROI and investments that you put in, you try to eke out of it. But if you have to grow, the companies, our customers have to grow, they have to, go deeper into technology, adopt AI, adopt analytics, adopt AI plus analytics, and quite a few of the new tech that's available to make sense of, the ever-changing customer requirements. So to that extent, you can stay away for about a period of 18 months. Now, like I said, macroeconomic factors have made sure that they did not cancel any contract, but they started prioritizing. They looked at more lights on contracts, what is their core business, and that's what they were investing in the last 1 or 2 years. But 18 months now into this kind of trend, you have to open up new investments into tech because obsolescence comes in. The new business that they want to seek out needs that kind of tech investment. So it's only a matter of it coming back. I'm not so sure whether I should use the word cyclicality, like the infrastructure and the capital business. But yes, there are reasons. If there is a reason to hold back technology investments, there are very good reasons for the floodgates to open as well. So that's what
I take that point. But in the second half of the year is also the US election. Does that in any way impact the way clients will look to spend, or will they hold back till the verdict is out?
Politics and economics, they are getting disassociated largely. And this has happened in large markets, and it's happening in India. And you will see more of it. So there will be some sort of, noise, and there could be something on immigration policies and the like. But largely, businesses drive their own agenda. And they have to make investments. They will make investments irrespective of the political dispensation. So yeah, there could be some small sort of disturbances, but that's for the now and here, but not for the long term.
Talk about generative AI, because unlike peers who've predominantly set up a center of excellence, Happiest Minds has made Gen AI a business unit. What is your expectation from generative AI? Will you start, classifying it as a separate revenue line item? Will you be able to quantify the revenues coming in? And you've also got plans to ramp up hiring, particularly for the Gen AI business unit. So take us through those plans.
Yeah, so unlike other companies, most of them have set it up as a COE. You're absolutely right on that. But we said, let's be slightly different from others. We are putting it right in front of our business, making it a BU, leading it with an executive board member leading it. Our CTO is the CEO of that business. So the kind of investments and the market presence that we want felt is what we have tried to, build up through the setting it up as a BU. That's one. Second is, when it's a BU, it gets a lot more of attention and focus from the customer side. I'm not saying the COEs don't get it, but from a customer side, you see that exposure. There's a direct exposure, and that's kind of helping us, because most conversations today with customers and prospects start with Gen AI. While we talk about all our other businesses, they do want to know what we can do to help them with Gen AI. So that's something that we are seeing. Gen AI as a standalone, project is not what we are looking at. There will be wraparound projects with analytics. There could be other automation built around the generative AI solutions. So all of this will feed into the BU that we have set up, and we will be calling out separate numbers for that, because that's the way we are viewing our business, and that's the way we'll also have to publish our results. So calling it out as a BU will obviously make it incumbent upon us to disclose those numbers. So these are the
How soon before you will be able to quantify the revenues from Gen AI, and what is your own expectation? Because you have a guidance for this year, you have a $1 billion guidance for the next 6 years. How much will Gen AI contribute? And again, on hiring, if you could give us specific plans.
So we currently are about 100 plus people in the generative AI, the BU, close to 80 going to 100 very soon. We'll also be adding the analytics and AI into this as we disclose our numbers. Disclosing numbers, we'll make an attempt this quarter, or it'll be the next quarter that we'll come back to, because we are just getting all our reporting alignment done. And those two acquisitions also need to be classified appropriately. So that will take us a quarter or two. And what we are saying in terms of sizes, the moment you call it a BU, it has to be a certain size. Otherwise, it doesn't gather attention. Today, PDES is about 80%. IMSS is about 20%. So Gen AI, if it has to become, it has to grab that attention from the customer side, and also from us internally. It should become 10% over a period of time, 10 to 15% over a period of time, and in course of time, it becomes part of the mainstream business like IoT. So that's a number that I would like to hold out.
Okay, final question before we let you go. The $1 billion revenue target that you have, if you could break that up into the revenue contribution coming in from sectors, because you are moving away and increasing your weight towards BFSI as well as healthcare. So from the current mix, what is the target ideal mix going forward?
Yeah, so EduTech is about 24% today. BFSI and healthcare is about 14%. Post this acquisition, BFSI, EduTech, and healthcare would be of equal size or near abouts that. So they really become the lead story for our growth. Along with that, we are doing pretty well on manufacturing and consumer CPG, retail and CPG. So all of this will be the growth story. So high tech, manufacturing, CPG, retail, along with the three, lead verticals of EduTech, BFSI, and healthcare would be what we'll be focusing on as we go forward. And as far as a target, that's more of a aspiration that we have put out there. It requires us to do about 22% growth CAGR. Last year we did 11, and we are thereabouts in that number, and we want to keep that kind of growth thrust going forward for the next 5-6 years.
All right, so we'll leave it there. Thank you very much for joining us, and good luck. And we'll sort of, have you back soon once again as we track that recovery for IT services, as you outlined, perhaps starts next in the second half of this financial year. We'll take a quick commercial break here. Markets down about 100 odd points. We'll have the management of Adani Wilmar join us on the other side to discuss their business outlook. Stay tuned.
Welcome back. You're watching us here on Bazaar Morning Call. The Nifty now down about 100 points. We have the mid-cap index lower by about 400 points as well. The Nifty Bank is the one which is leading the decline, but it's still contained as far as the first hour of trade so far is concerned. Let's talk about the edible oil space now, because in the fourth quarter we did see, after a big decline in prices, there was a surge in the fourth quarter for palm oil prices, soy oil, seeing a near double-digit surge as well. So what's the outlook, the demand out here, and also, what companies are planning? We have Anshu Malik, who is the MD CEO of Adani Wilmar, joining in now. Thanks a lot, Anshu, for joining in. And that really is the first question. There were increases in prices that we saw in the fourth quarter. How have they panned out in the first quarter so far? How is demand? And in light of that, what's your outlook?
The demand in the first quarter has been, I would say, quite robust. And the industry is also growing, and we have also done well. Double-digit growth is what is expected in Q1. The industry is also growing at that. The prices, although it has gone up, it has come up from the bottom. So consumers still feel the prices are comfortable, and we see good consumption coming in. That is what is the primary observation.
And how much have the prices increased by in the first quarter?
Almost 5% to 8%, depending on different oil. In mustard oil, it has been almost 8%. Palm has been steady or a little more. Cottonseed oil has grown up, but sunflower oil has grown by around 2%, 3%. So different oil has changed in a different manner. But overall, the basket has gone up by 5 to 6%, you can say. And consumption has not been it.
Okay. And you expect this price increase that we've seen to sustain going forward? And also, if you could help us with the volume growth estimate for FY25, or what we've seen so far in Q1.
See, we are talking of volume growth, and we expect AWL to do double-digit growth, although the industry is growing at around 6 to 8%. That is one. Two, going forward, the prices are likely to stabilize. There is a supply chain issue, so the prices have gone up. I think with the Argentina and Brazil shipping becoming much more easier, things will improve. One. Two, we are all looking forward towards a good monsoon, although the monsoon so far has been little delayed, but I hope July, August, September it catches up. And Kharif crop is a big crop because we look at cottonseed oil, groundnut oil and soybean oil. So these are the three big oils that we expect from October harvest.
All right, so let's talk about margins then in the very near term and the end of this year as well. In the very near term, because of increase in prices, I'm sure you'd benefit from the low priced inventory that you have. So in the first quarter, what are the kind of margins that we can expect? And for the full year with stabilization in oil prices, what's your target?
See, normally the stabilization of oil prices leads to better brand sales, and that we are seeing. Brands, Fortune as a brand has come back into full, I would say the full quantity that we used to sell earlier. And we are seeing good growth in Fortune as a brand. That is one. Two, I think the margins are likely to improve over the last year, Q1, Q2. And that is surely we are seeing. And going forward, I think FY25 should be better in terms of margin, in terms of volume growth, and stability in terms of overall business environment.
So your volume growth guidance is double digit. Do you have a number in mind what you can hit in terms of margins this year?
Margins will be difficult for me to say upfront, but I can always say that it is better than last year same period.
All right. What about things that you can say then? You know, food and FMCG, how much will that be as a proportion of your sales? You were looking to take this up to almost 20% at one point in time. And your market share, because the market's growing mid-single digits, a little more than that. You are growing double digits. What's your end of the year market share aspiration? So on food, FMCG and market share, what are the two numbers that you can give us?
See, as a company, we expect double-digit growth in edible oil. Food and FMCG basket has been growing at 20% plus, and we hope we will continue with that 20% surely. Industry essentials, particularly oleochemical business, DOC and animal feed business, plus the castor oil, all this put together, we expect 10 to 12% growth. So overall, as a company, the volume growth will be higher than 10%. Then comes to the stability part of it, or the market share part of it. We are growing faster than the industry, that is for sure. The brand Fortune and edible oil, refined oil consumer pack, we are growing. Nielsen says we have grown at 9% against 6% of the industry. So you can assume that actually the trend will be a little higher. In Atta, we have done well, and the market share has grown from 5% to 5.9%. Basmati rice, we are still not able to grow as fast as the industry, and we hope to catch up soon because of the strategy that we are lining up. So overall, food basket, besan, nuggets, all these are growing at strong double digit.
So in light of all of this, have you decided on the plan to meet minimum public shareholding? Because, some of the other group companies are looking to raise funds. So I just wanted to understand whether Adani will be the one reducing its share, or will it be Wilmar? Currently, promoter stake is about 88%. You have time till Feb 2025.
See, as part of the mandatory thing, we have to dilute 13%. That we are working on, and hopefully in coming months, we will go to the public or whichever way the organization or the promoters decide. But surely we have to dilute 13%.
By we, you mean the promoters at large, both Adani's and Wilmar, right?
I think yes.
Yes. So, no, I just wanted to know, will it be 6.5% by both of them, or will it be 13% by one of the partners, or one of the partners will look? I'm just trying to understand.
That I think the promoters will have to decide. We as professionals have not much of say. Promoters will decide whatever is best for the company.
Okay, well, we'll leave it there, sir. Thank you very much. Good speaking with you, and good luck It's a pleasure having you with us here. Well, now let's talk about the outcome of the 53rd GST Council meet, which took place over the weekend. In terms of key decisions, GST Council has decided to roll out Aadhaar-based GST verification in a phased manner across the country. The issue of rate rationalization on fertilizers has been referred to the group of ministers. And of course, I mean, there is stuff which has been done, stuff which has not been done, and we'll talk about both. Pratik Jain is partner at PwC India, and we also have MS Money, partner GST at Deloitte India. Gentlemen, great to have both of you here. Thank you very much for joining us. Prashant this side. Pratik, if I can start with what is top of mind, which is online gaming and casinos, right? Now, there was a fair bit of a lot of newspaper headlines which essentially said that there has been no relief. Nothing was discussed, no relief for this particular sector, where there was clarity which was awaited. But I just wanted to get a sense from you. Is that how you would read this? Because, you know, they are essentially introducing an amendment in Section 11A, a clause which enables the waiver of retrospective taxes. How will that, is that not some a glimmer of hope, relief aimed at not just one sector, but which perhaps enables relief for not just online gaming and casinos, but other sectors as well? Just explain this for our viewers, please.
No, absolutely, Prashant. There is a glimmer of hope. More than a glimmer of hope, I would say. I think the government is perhaps contemplating to use that provision to provide relief to certain sectors, perhaps online gaming as well. So what has happened in this council meeting is that they have now approved the enabling provision, which allows the government to provide retrospective exemption. That kind of provision was there in a pre-GST era in excise laws, etc. That was not there in GST law. Now that provision will be there once the amendment is passed, which is likely to happen in the budget session. After that, the government can provide a retrospective exemption, and perhaps the online gaming would also find favor at that point in time. Of course, government will need to take a decision. In this council meeting, nothing has happened on gaming per se, but once the enabling provision comes in, I see a possibility of that happening.
No, so this will now have to be, so this it's a process, right? This will have to be taken through the parliament?
Yes,
Pratik?
this will have to be taken through the parliament because amendment in the act. And of course, once that happens,
it then comes back to the council, and then I think they'll have to take it up sectorally, right? I mean, they'll have to apply this.
Absolutely. Correct.
But you know, so names like Delta Corp, etc., right, which runs casinos, has been under pressure. It's a. Would you again? I mean, without sort of talking about specific stocks or some companies, would you say you said this is more than a glimmer of hope? So it is material in that sense.
Yes, I mean, look, ultimately, whether the government wants to provide relief to the online gaming or not, that's for the government to decide. What I'm only saying is that after the enabling provision comes in, then government can not only do gaming industry, they can provide, there are things about, foreign airlines, shipping lines, and so on, right? So now they will have power to provide retrospective exemption. And I think that power will be used. Now, whether it will be used for, online gaming or not, that remains to be seen. But what we were reading in the media is that the government was contemplating. So if the intention is to provide that exemption, then that provision is likely to be used once the act is amended.
Mr. Money, is it a bit of a, as Pratik and I was discussing, is too much a leap of faith to expect? I mean, one can argue and say that if they did not want to provide relief to the sectors which were affected, why would they introduce this amendment? Is that the right way to look at it?
I would actually go one step behind that, Prashant, to say that more than anything, what the amendment is that there is a genuine desire now on part of the government to recognize trade practices and business practices which may not be aligned with GST. And trade practices, business practices are unique to each industry. Online gaming has had certain, manner of calculating, whether it is the gross gaming revenue, whether it is anything else. Each sector has had a different way of operating. And those practices have been in vogue since a very long time. It's too much to expect the business, all businesses across a sector to change their trade practices just because the GST law cannot be interpreted in a straitjacketed manner. So having a provision which says that we henceforth will recognize trade practices, business practices, provided it is uniform, is to me a great step that they have taken this time. As far as online gaming is concerned, I don't think there is any reason to feel doubtful on whether it will be applied or not applied. As Prateek said, we will obviously have to wait and watch in terms of what exactly is the notification and how they interpret this for them. But on a broad basis, this also is an issue that has arisen because the business practices are not aligned to the GST law. And now that they have taken the power to recognize various trade practices through obviously separate notifications. Insurance is one of them where they have already given a clarification for the future. And they have also said that the existing matters will be dealt with on as and as is various basis. But even that will require a recourse to Section 11A at some point of time. So to my mind, this is a step that ideally should have been in GST when it started. But the fact that it at least coming now is fantastic for all businesses.
Yeah. Do you expect, so two things. One, I was telling Prateek, a lot of the newspapers, over the last, yesterday, today, etc., as well, no relief for online gaming, etc. You would disagree with that, right, Mr. Money?
I would say that an expectation of an instantaneous release, an immediate gratification for online gaming companies was possibly not, in place.
Maybe that was, that was not a correct expectation as well.
But
so that brings me to the second point. Now we've got. Do you expect this to be taken through the Parliament this session?
Absolutely. So my sense is that the reason why this GST Council meeting took place on the date on which it took place is because the legislative amendments that they wanted to propose, they could take up during the budget session of Parliament.
Immediately.
Together with the finance bill. And therefore, once the finance bill is passed at that point of time, they will be free to introduce the new sections and all the other legislative amendments that are required.
Okay. Now, Prateek, two questions to you. One is anything else which stood out to you from the council meeting with important implications? And second, there's expectation of gas being included brought under the ambit of the GST. Now, again, it's not come through. It's not, they've not ruled it out. They said they will try, right? That's what the finance minister said. Your thoughts?
Yeah, so the first question first, I think 2-3 things will stand out. One is that there is some sort of amnesty scheme that government brought in for GST past demands for years 17-18 till 19-20, where if you pay tax, then interest and penalty will not be charged. I think that's very significant, particularly because there was a Supreme Court judgment in case of Northern Operating, after which a lot of companies had to pay GST on secondment of people coming from outside. There, a lot of companies have paid tax, but on interest and penalties. Now, interest and penalty will be waived off, not only in that case, but any other case where there is no fraud, etc. is involved. So that's important. Second is anti-profiteering provisions. There is a sunset clause which has been introduced. A lot of us were having a view that anti-profiting provision was supposed to be there only for a short period. And it's been almost 7 years since GST has been implemented. It helps the businesses to decide the pricing and let the market forces apply. So anti-profiting provision is extremely important. The last in my list is rate rationalization. There is a group of ministers which was constituted earlier for rate rationalization. Now that GOM is being sort of reconstituted because a lot of changes have happened. Now Bihar Deputy CM is going to be chairing that. And I see a hope that in the next 12 to 18 months, the GST rates will be simplified. As far as gas is concerned, I think that there is a good chance that ATF and natural gas will be included at some point in time in GST. Hopefully, some of those structural changes will be discussed in the next GST Council meeting and subsequent. There was a larger consensus on gas, I think, which is emerging. We'll have to see how much time will it take, but it should come in GST sooner than later.
Got that. Fair enough. Ms. Mani, you want to add anything to the list of what Prateek already mentioned?
Yeah, a few more things. One is in terms of intent, it was very clear that the objective was to really simplify GST. And couple of data points in that in terms of the fact that the government is really sincere about really making GST simple for businesses. One was the statistics that was mentioned, which said that less than 2% of the effective taxpayers have been issued a notice. It's not that there are notices issued to everybody. The other is the fact that I'm seeing for the first time that there is now a threshold limit faced for the tax authorities to file an appeal. So they have come out with 3 different threshold limits for appeals and for High Court and for Supreme Court. And below that, they will not be able to go ahead and file an appeal unless there is a malafide which has, occurred. So the mechanical manner in which the revenue authorities would go for increasing the litigation and, choking up the entire litigation process will now come to an end. I just wish there were something similar where businesses did not need to appeal up to a certain threshold, where there were repetitive, matters. But the fact that they have looked at it and they have looked at various other measures to really simplify the ease of doing, business, to me says that the next phase of GST, as we move into the 7th year of GST, is going to be about how do we make it simple for all businesses? How do we take away the pain points? And how do we really listen to what the industry and trade is saying and then act on that? That, to my mind, was the biggest takeaway.
All right, gentlemen, thank you so much for joining in and adding value to, the GST meet.